Hi, this is Jeremy with Strategic Advisory Services. We have something very new, very exciting to share with everyone. We're going to be doing a weekly market commentary video, economic commentary, headline discussion. We just want to help be a filter through all the noise and help folks make good decisions. First, I'd like to thank Michael Wellings, our Communications Director, with this idea. We think it's a great idea. You'll see me, you'll see Dick, you'll see some other folks in our office on this video, and we look forward to doing it. And also, we're very interested in your thoughts. We'd love to have your feedback on it. For 2017, we started the year very smoothly. Well, since the election, the market has just almost gone straight up. We've had a return of volatility this past couple weeks. The Fed's raising interest rates. There's a lot of systemic risk, and we're going to talk about those throughout this video. But in terms of volatility, when this happens, the bears come out. We start seeing headlines that are depressing, really. We start seeing headlines that incite fear. It's very important that we ignore those headlines and think about history. We've always had volatility. We've always had bear markets and market corrections, and we've always recovered. We build plans, we diversify, we focus on a long-term asset allocation approach to help ride through the volatility. We certainly can't do anything to just avoid it. It's expected, and it will continue. It's going to continue, for one, because the Fed is dealing with interest rates. They have a target Fed funds rate of 2%. Well, this last week, they increased them another 0.25%, and they're halfway to their target funds rate. Why a Fed funds rate of 2%? Well, in my opinion, probably the biggest thing is so they can stimulate or slow down the economy. They can lower interest rates if things start getting pretty bad, if we start going to an economic recession. By lowering interest rates, it stimulates things, puts money in the consumer's pocket. They can spend more. They did that in 08 and 09. That's the whole reason they're trying to raise them now. Or they could actually increase interest rates above 2% to help slow things down if we get into a hyperinflationary environment like we had in the early 80s. Janet Yellen has made it pretty clear. They're only going to raise interest rates if things are in agreement. If unemployment, if GDP, if the markets, if all things are still doing well, they'll keep progressing towards that target rate. We expect 2 more this year, and with that we expect more volatility from it. Also this week, we had lots of headlines about retail. Retail is obviously changing. The way consumers spend are changing. Michael Wellings, his headline for it, Retail Store Apocalypse. JCPenney announced a loss of 138 stores. They're going to cut 10% of their business. It's going to affect 5,000 employees, and it's going to continue, and it's going to get worse. Just today, we had 13 more major retailers announce layoffs, announce store closings. It's because consumers are changing the way they spend money. We have a capitalistic economy, and if these companies can't change with it, it's going to continue, and it will create volatility. It certainly will. Look at Walmart. Walmart is your classic, your quintessential brick and mortar store. We've all been in a Walmart. But if you go to walmart.com lately, it looks a whole lot different than what you'd expect. It looks like amazon.com. It's their response. It's their response to the changing consumer. Amazon started offering free 2-day shipping many years ago if you're a Prime member. Well, now Walmart's offering the same thing. You don't even have to be a member for that. They're trying to keep up and be competitive. These other companies need to get on board, or we're going to see more retail store closures and more market volatility. Our expectation, though, is that the consumer will always dictate how companies are designed, how companies arrange them, because they want to make a profit like everybody else. That being said, if you know somebody affected by layoffs, whether it's through the retail world, oil and gas world, when that occurs at the individual level, it's devastating. And bad decisions can get made quickly, and they could affect that person and that family for a long, long time. Encourage them to find and seek advice from a trusted advisor. If they're in Houston, we'd love a chance to meet with them. Even if they're not, we have clients all over the country. If they have someone they trust, encourage them to reach out to them, help them make good decisions through a difficult situation. In other news, we've had lots of systemic risk this week through the government's healthcare debate, through terrorist attacks in London. That systemic risk will also continue. Lots of volatility is caused by systemic risk, and that's something you can't diversify away from. Systemic risk is not something you can just sell away from. For instance, if company XYZ, you know they're going to come out and their profits aren't looking good and they're going to make an announcement, you could sell away from that, sell that company to avoid the risk. With systemic risk like terrorist attacks and healthcare debates and government and all that sort of stuff, just got to ride through it. It's happened since the dawn of investing, really, and it will continue. We expect to continue. That's why we build plans. That's why we focus on the important aspects of a long-term investment process. We thank you for watching this video. We look forward to your participation. We love your thoughts, your ideas. We'd love to hear topics from you. If you're asking the question, chances are lots of people are asking the question. This may be a great way for us to get that information out there. Have a great weekend. Have a great week. We look forward to doing this again next week.